One. All right, let's get started. Uh, I'm gonna walk through today the fundamentals because it's been long enough that reassessing fundamentals is warranted, and then its effect on the options chain, its effect on the ETF models, its effect on the full model, its effect on the oscillator, and what my interpretation of the technicals are, and what my interpretation of the swapinator and the probably bottom finder as well are. Okay, so let's start, right? Fundamentals, right? Right here on these two rows are earnings per share history, okay? And so we can look and we can see that in quarter fours, Q4, bad Q4, but Q4, let's start with RC being present actually. Q4, Q4, Q4. We can see our quarter fours are actually pretty fucking good, right? And so I expect our quarter four is going to be good. But contrast Q4 to Q1, right? And you'll see we usually dip. In this scenario, we lost 30 cents per share, or 30 EPS, right? And this one, we lost again around 35 EPS, or 35 cents per share of earnings. And in this one, we lost around 20 cents per share of earnings from Q4 to Q1. So why is that? Um, there was an announcement of GameStop closing down New Zealand branches, and that we're gonna close around 100 or 400 stores, give or take. Uh, that is a pattern. It's a pattern that I've had here. It's a pattern that I've been predicting we do going forwards. Where year over year we had been shrinking by around 20%. And so I have predicted that going forwards myself for any predictions I make, right? And so I should probably like actually just boop. There we go. Okay, fine. Um, but what does that say, and how does that impact Q1, right? My own interpretation is that on Q4 we make a lot of money. On Q1 we decide whether or not we want to continue stores as operational, and then SG&A costs for running the store fall off in around a year and a quarter. Uh, so depending on the closures, I expect, let me see if I can find, here we go. So depending on the closure quantity here, I expect we're going to see a higher or lower gap here, right? I do not have data this far back, should I? No, I do not. Dang it. I need data that far back in order to actually tell. So this I cannot tell. This I can probably tell. So what was the Q1 drop? Right here, the year over year drop was 6%, and it resulted in a drop of 30 cents per share earnings because we were still paying SG&A costs for 6% of the company. But over here, we had dropped 20% year over year of this like size of the company, and we had lost 20 cents. Uh, my general interpretation of that is that I don't have enough information to make any calls. But the general consensus that I have is that in Q1, we're going to lose top line. We're going to lose revenue. We're going to lose stores. In Q2, afterwards, we're going to see the recovery of SG&A from a year ago and a month ago when in January we closed stores. And so I expect Q1, this is going to be way too bullish, and we are going to miss on Q1. So if you take the presumption that we're going to miss on Q1, and then you search for, let's look at the options chain. Let's now take that and let's compare it to what information is publicly available. If I presume that Q1 is going to miss, let's also look up GME earnings estimate Q1 2025 or 2026. I don't know if earnings estimates are released yet, actually. Let's just look up GME earnings estimates. I don't care about the beats. I care about getting an accurate-ish earnings estimate. This will do. Right now, we are predicting a, what the hell is that number? 37-cent earnings per share. And my own prediction is 28. And so I expect this is going to be broadcast as a miss, despite this being a wildly successful quantity of growth, in my personal opinion, to go from, I mean, it's it's actually just the company shrunk by a good 20% and the earnings stayed the same. And I see that as a lowering of risk in my own opinion. But the other quarters tell a story of how this is good for the company at large. Anyways, I expect this is going to be a miss though. If this is a miss compared to estimates on Q4 and on Q1, let's look at the options chain for Q4 and Q1. GME earnings date. Into March, right? Let's look at the options chain for mid-April and into March, or March. So April has a GME1 chain, right? April's GME1 chain is hovered on 17, a massive fuck you wall on 17. And then there's some open interest on 20, 23, and 25. Okay. So people are trying to trade 20, 23, and 25, but there are a fuck ton of strike 17s. Oh, it's really just 300. There are not many. So this is open. It's just, I expect 20. I personally expect 20. We will find out in due time, but the story the open interest tells me is 20. Max Payne, I think there's not enough actual open interest here for me to know, because there's not many fucking calls. Like 300, come on, that's not enough trading. Yeah. Let's look at January, because January was very interesting in and of itself. There is a call wall at 20 a share already, and there's another one at 25 and another one at 30, and there's also one at 16. Okay. I expect that we're going to end just about at 20. We're going to end just a bit below 20, to be honest, if I think about it on Jan OPEX, because that is where Max Payne is. That is where we minimize delivery of options. And so I full well anticipate that we're going to be around this 20 call wall on the 16th. And let me show you on the technicals this, okay? So what is this chart? Because this is fucking insane looking, right? These red lines are just the rate of decline, right? I'm going to delete a lot of this stuff, and I'm also going to hide the divergence for mini indicators, okay? Also delete that because it's not important. So this is just a vague trend line down. This is just a vague trend line down. It's not actually that important, but these are all the same line. And so the idea is we give or take decline at the same rate, okay? And so I expect if we continue declining at our current rate, we would hit 20 or maybe slightly below 20 on the 16th or operations or OPEX for January. And that would line up with minimizing the delivery of warrants, okay? And so that's my going expectation for this week, right? Is that we just continue to walk ourselves down into OPEX, because OPEX is going to be fucked. Like, now let's take that. Let's take that, and then, so I do not like what they're setting up for after Q4 earnings report. I do not like for what they're setting up for after Q1 earnings report, for how the stock moves after these things. And so let's take that and let's compare that to my only model, which even looks out that far, or the full model here, okay? So full model, if I zoom in, has been, as of late, completely inaccurate on the peaks, because the peaks are now troughs. As of late, the echoes of FTD delivery have been used as a reason to suppress the stock, not to let it run. And that's been fundamentally different ever since I showed up. But that's fine, whatever. That's batshit crazy to me. But we hit a low on the peak, and then on the trough right afterwards, we also hit a low. But in this time between, we do have the capability to rally, it seems. So after the absolute bottom, we rally for a bit. And then in the actual FTD due date, we seem to be crushing it, crushing the stock out. And then I believe the bottom is called for 16th, and then another on the 22nd. Okay, so it thinks the 16th and the 22nd, which are the 16th is Friday, the 22nd is the next Friday. So it thinks for the next 2 weeks we get crushed out. Okay, for options. Perfect. Fine. Fine. But I think personally that sometime in this area from the 16th until the probably mid-February, there will be the capability to have some sort of rally, but we will probably get crushed out of that before February 10th or so here, because every single time we hit that peak, we're already down. We're already down. We'd probably already be down here. And then by the time we hit February, like 19th or 23rd or something like that, let's also say on OPEX we get crushed in February. 20th. Yeah, let's call 20th. No, let's call 19th or 18th there. By that time, we would probably get crushed out again. That's just what it's reading as to me. Because this chart is supposed to be correlated. It's supposed to have basis in reality, but it seems to not lately. And that's completely okay because these are fucking models. Next. Let's now compare this full model to, I believe, yes, I have the swap model right here beside it. What does the swap model overlaid on the full model think? Let me zoom the fuck in. This is actually very fucking hard to read. So let's just look at the ETF model separately. So the ETF model. Two of my ETF models are very unhappy with me right now. Okay. The B model is completely not tracking, and the C model is completely not tracking. Now this could be very good, like it was when it completely stopped tracking here in April of 2024 and then started tracking again in May of 2024. You'll see how we went through January, February, March almost tracked, and then April, and then we started tracking again. I expect we would see a similar thing where we can look at the options chain and get some sort of bearing on which expiries have the most likelihood of actually being delivered at a higher price. Where the more people actually fucking trade this, the less likely it is to rally, because that's how it works. God bless. Okay. So I expect this is going to get crushed out. On the C model, this is going to get crushed out on the B model. And I'm going to have to find a way to fix the correlations back, because how these are made is, let me show that. Over here, down here. Let me just walk through top to bottom how this is made, right? So this is the creation or redemption of ETFs. This is the number of shares outstanding. Market makers have the capability to demand the creation or redemption, which means making this number larger or smaller, of the number of shares outstanding of ETFs, okay? This is the net change. This is the ETF models, okay? It is standardizing the average and then multiplying by a constant, okay? And then for the FTD part, for some of these, it's just taking the number of FTDs per, let's show the FTD page. It's taking the number of FTDs per security, and I have quite a few securities tracked here, and it's just multiplying by a constant and then adding that, or subtracting that effectively. And so failures to deliver would send price down in the models effectively, and ETFs would send the price up, give or take. And then that is created into a calculation and then averaged together to some extent, or smooth to some extent. And then taking that and optimizing that for highest correlation creates these models, okay? Now the difference fundamentally between these models is that model A that we're about to look at is every parameter I can possibly include, and it is optimized for correlation over a 1-year history, okay? And so the correlation for model A is sitting at 90.5%. with a correlation squared, or RSQ, of 82.9%. And that is highly correlated, but you should understand that judging a model based off of the criteria in which it was trained on is how you get a bad judgment on how good the model is. And so this could or could not be accurate. these all say different things, and that'll tell you a lot about how accurate they really are, um, which is useful. Okay, so looking at the A model, it thinks, and it thinks we're going to see volatility on the 22nd here, or 21st actually. 21st is interestingly not OPEX. That's fine. It thinks we're going to see volatility on the 21st. It thinks we're going to see something on the 15th as well. It might even think we're seeing something positive on the 13th. Um, I am of the opinion, as of late, that these ETF models are very, very useful for telling volume of trade being created, because trading, forcing ETFs to trade back and forth is a great way to create a counterparty for whatever trades you want to have done. Okay. And so I don't think we're guaranteed to have a rally when these models call for a rally anymore. And I don't think it was ever guaranteed. I just thought it would be highly correlated, and it doesn't seem to be highly correlated as of late. Um, and that's okay. I will recorrelate these models on my own time. Um, I don't care to do it right now. I should be in streamer mode for Discord. Oh well. Suffer. Okay. So, from there, right? Words. Words, words, words. Okay. In January, the A model calls for something on the 21st, and maybe even something on the 15th here, right? In the B model, it thinks we ramp all the way up, all the way until the 12th, and then it doesn't break that at all for a while. I don't know when this will break off. It's not started yet. Um, the C model thinks that there is something going down on the 16th. We could go up as well, but there's some sort of volatility event from the 14th until the 16th on the C model. Okay, and the C model has been tracking peaks lately. So if we on the 14th see upwards movement, then I would be scared of on by the 16th getting crushed out, just completely crushed. As of late, we've been having a cash floor of around 20 a share, but if this is enough volatility to crush down past that, it's enough volatility to crush down past that. But I think this entire upwards movement of the C model was volatility created in order to crush the price. Okay. Selectively fulfilling trades is a fun concept. Okay. And the D model has been forecasting, and it forecasted some sort of volatility here. And it, like I said, it thought it was supposed to go up. It went down. It thought it was supposed to go down. We went up. I don't know if this thing on the 21st is going to be bearish or bullish. I just don't. But it's forecasting volatility, right? And that is on the 21st, and then it gets crushed out by the 26th. Let's compare that to the full model. 16th, 20th, 22nd. So something here on the 21st is volatility on the full model. And then 26th is also something happening here. Okay, give or take. Fine, what have you. So let's look at the overlaying of all of these on top of each other, because I don't think I have that conveniently available for individuals to see. Yes, I do not. Let's go ahead and add that. Okay, add another 2, 3. This would be, that's A. This is B. Let's look at B model. AH. C model. AO. And D model is AQ. Okay. Let's look at these overlaid on top of each other. So this is the aggregate of the ETF models that I have together so far. It seems to indicate across the board upwards movement for every one of them from the 16th until the 21st. Every one of them seems to indicate upwards movement. And so that might be a sign that we actually move upwards from Jan OPEX on the 16th to actual the 21st, which is Wednesday of the next week. I'm fine with that. That would be fun. But also, I don't know. A few of them predicted decline afterwards. We'll see. We will definitely see either way. Full model has been right here. Okay. Full model is happy with the 16th being a low, and it's also happy with the 22nd being a low. So that's fine. Okay. The last model I have is this swap page, right? Now the swap page exists because I was under the impression that swaps were on a 3-year timeline, okay? And that if I was trying to build up swaps as a hedging medium or as a way of tracking out hedging before or after it occurs, then I might as well just manually say that local minima in price or a dip downwards in price and then a recovery afterwards with swapinator activity to boot to like add into that was a swap for this model, okay? And all this is charting those out manually, fucking manually. And so let's show that, right? It looks pretty accurate, right? Looks like it from here, but let's prove, or let's look at it with our fucking eyes, right? So this yellow day is, drum roll please. There we go. 1/19/2023. And this one, that's not it. And this one is 1/28/2020. So let's look at 1/19/2023 on GameStop. 1/19/2023. 1/19/2023. Okay. So this local minima right here, and then the recovery for 2 days afterwards is what signifies, or to me indicates, that there might be a swap on this day, 1/15, not 16 apparently. And it could be wrong, but it's sometimes off by a day or two. Anyways, it indicates to me that there could be a local minima on 1/15/2026, right? And then 1/28/2020 seems to agree. 1/28/2020. Oh, God. This is going to be in the middle of the fucking squeeze, ain't it? That's a bit hard to chart out. Okay, is 1/28 this? Okay, it is. It is. It's just this downwards movement. If this is a swap being entered, then this is a swap being entered. That's fine. That's a little obviously a local minima in daily price. Fine, whatever. Okay, fine. Put those back to where they were. And those are what's being seen as hitting on 1/15. And me saying that is why OPEX on 1/16 is probably going to get crushed down. Okay, let's convey with the swapinator. Right? Let's convene with the swapinator. What do they... No, I do not want to ruin half my model. What does the swapinator think? Zoom, 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 zoom. The swapinator at the moment is on a slow ramp up. I expect that that ramp up would hit on the 15th or 16th for OPEX. The 16th for OPEX would be warrant delivery. The 15th would be a swap, apparently. Fine. We're heading into a swap. That's my personal opinion here. What comes next? Thinking emoji. 21st or 22nd would also probably exist. Let me make my callouts then, right? My call out. Let's talk about risk on criteria. What do I want to see? I want to see for me to pick up leaps. I don't think I'm going to call this the big one because we still have future options expiries that are probably going to crush us down. And we had quite a few of these last time before we actually... Yeah, here we go. Let me show full model. No, let me show ETF. We had quite a few of these in my ETF model before we actually did anything like this, right? 1, 2, 3, 4 type shit, right? We started breaking away like this before the last squeeze. Fine, whatever. I believe spring, around April, after April, start of May, is when we might actually see something. Maybe after March at minimum. But the April chain exists for GME1. The June chain exists for GME1. Um, there's no March chain. So we could see something in March. We could see something, but they would want to crush it down by April. They would want to crush out in June. But I expect that somewhere around spring we would see something. And that's my own opinion. Okay. Let's go into. So I don't think it's time. I'm seeing a lot of irrational exuberance. So I think we might even see a new low. Because it's too much irrational exuberance for us about to being crushed into a swap, right? This is just obviously we're getting crushed into a swap, but the irrational exuberance makes me think we might even go lower than our previous bottom and just like slap 19 and then come back, and that would be on the 16th on operation or OPEX day, but that's fine. We might see the 16th and then the 22nd or something like that, but me, I like buying leaps. I like buying leaps when we are really, really, really cheap. Risk on criteria for me is a 20% decline from the top. What is the top? 2350? Let's call it 2350. Maybe 24. What's 2350? 20% decline is 19. Yeah. If I see below 20, I'm game to buy leaps. If I see it on swap day, I'm so game to buy leaps. Yeah. So if on the 16th or the 15th I see below 20 a share, I'm game to buy. I'm down to clown. And like I would expect that sometime before end of February, we would see some sort of revision and then a crush back down uh, in order to get, options kept under control. Mm-hmm. Yeah, that's accurate. That's accurate to my opinions. What else have we got? What else have we got? So I have walked through what the ETF models say. I have not walked through why this thing can happen, this thing right here, because there's a few reasons. Interesting reasons for why this can happen to my ETF models. The first one is that, here we go. The B model and C model are based off of a cash floor. The cash floor as a concept is that there is only so low that the models can go, okay? If we are undergoing high quantity of creation and redemption of ETFs and high quantity of FTDs, then the model is going to struggle because it cannot go negative. What does that matter, right? Let's show the C model without smoothing. Did that do 1%? I want 100. I might break it. I don't know the formula. It's either 0% or 100%. What model did I just break? I think I just broke the A model, not the C model. Would like to break the C model. 0% smoothing. Then we're doing that linearly. Let's go into the C model. C calc, C model. C model is an average of the past 6 days beforehand. C model, you are now being equivalent to the number you solve for, and you're being dragged down. Good enough. I'm going to control Z this in a bit. Okay, cool. This is what the C model looks like, okay? These downwards days, all the way from October, all the way to December, could, in theory, send us very fucking low, okay? So you'll notice how I am hard blocking us all the way from June to all the way into August from going negative or going below the cash value of the company. And then when we see refillment all the way through August through September, the price doesn't improve. When the price does improve, it's because we have started passing by all of this improvement, right? And that's my own opinion there. Cool. Generally speaking, I expect this 16th day it might be a low. This 22nd day, it might be a low. I love how this also lines up on the fucking ETF models. Oh my god. Anyways, I'm looking for a good price. That's what I'm looking for. I'm not looking for anything else. I'm looking for a good price. I'm looking for that's it. So, that's what that looks like. Let's control Z all of this because that's what's happening under the hood for these. Okay, we're back to normal. You're back to normal. And that's why I think it could be breaking in front of our eyes. Okay. What I'm looking for this to be a trustworthy model, again, give or take, is looking for this to revert back to normal somewhat, and I'm looking for it to then predict uh something or other. I don't know what. But here we go. That's what I think could be happening. The other thing that could be happening is it could be predicting volatility, and then we express the volatility, and the volatility is not in the direction we predicted. And that could be because this model is correlation and not causation. And you can correlate your ETF creation or redemption with volatility, but that doesn't mean it's caused the volatility. Okay. Thinking emoji. So let's go into whatever the hell this is. This divergence for mini indicators, right? This has been one of my favorite things to play around with lately. And so all it is, settings, it is a list of technical indicators, and all you're doing is you're playing around with the type of divergence of regular or hidden. You're looking for what indicators you're looking at, and then you're trying to add periods for pivoting to show the indicator, okay? And so the indicators can appear or disappear based off of what your time frame is, because all it's doing is like churning out technicals. So like we'll see a bullish on the hourly. I actually expect that the bearish and bullish signals can be somewhat ignored when we're in larger criteria. Like this bearish signal didn't mean jack shit on the hourly. This bullish signal didn't mean jack shit on the hourly. I mean, it did kind of, but you comprehend where I'm on. Anyways, I look personally on the daily, and I am looking for a bullish signal, non-confirmed bullish signal. So if you go here, settings, don't wait for confirmation, you know? I'm looking for an unconfirmed bullish signal around below 20 a share on the daily on the chart. And I don't care what technicals they are. I just want to see them. I'm not a technical guy. I find things to do that for me. For Swapinator, I'm looking for a fucking peak. I'm looking for this to peak. For Bottom Finder, and I don't have Bottom Finder added to this, so I'm going to remove the Swapinator, save. I'm looking at the Bottom Finder. Use on chart. Here we go. I'm looking for this to open. I'm looking for this to open. I'm looking for this to flag in the next week or two. Okay? We're not flagged right now. It's not a good time to buy. But, and then kill this. Actually, I don't even need to save. That's all. Okay. And then there's one more. What am I forgetting? Swapinator, Bottom Finder, Kitty PMO. PMO is really interesting. Use on chart. I would love if this were to flag. This might be a bit of a pain to show, actually. There's a way that this works that I am incomprehensible towards, but it exists. Somebody smarter than me will tell me if this works or this doesn't work. I know that this is a very good correlation. I just don't know how to fucking use it myself because I'm a little bit of a degenerate. What else is there? Okay. Yes. That is useful. So we started with macro of what I think the company's doing. I see very good performance in the future. I see Q1 not going as well as we thought. I see Q4 going as well as I think, but that being used as an excuse to crush the stock out in March. I see Q1 underperforming. I see Q2 being a wild breakout again, as it was previously. And so that can then be applied to the models. I can then look at the models with that as my lens. I can attempt to comprehend what has happened and how the models have been wrong previously. And I'm not really open to changing the data right now, but I am open to pointing out how and where this is wrong. And it is wrong during the peaks. It is wrong during the peak, and then during the trough, it's very low. So during this trough, I expect we're going to be very fucking low. During this trough, I expect we're going to be very fucking low. But I expect we might even recover going into the peak and then get crushed out again here and get crushed out again here. And that's February. But if we don't get crushed out, we don't get crushed out. I'm not really attached to this working out how I want it to. ETF models are fucking weird, maybe a little broken, but they're good for volatility. I can take the ETF model volatility. I can then compare it against the fucking minimum prices that I like. And I can compare that against the options chain and the swapinator and find whether or not I want to buy. Generally speaking, though, I'm looking for a high on the swapinator. I'm looking for below 20 a share because that's where I think warrant delivery is going to place us on the 16th. And I'm looking for the ETF models to show something interesting, right? I'm looking for that 16th. I want to find out about the 22nd. And with that, I think that's where I stand. So let's be comprehensible. Let's be comprehensible for a second. Let's go into, was it here? Was it here? It was here. No. Where do I want to make notes? Let's make notes on the full model. Let's make notes on the full model. Let's call expectations. Let's do 1/12/26 through what day? Let's say 1/19/26. Right? Let's not even supply a date. Stepping below or around 20 a share. Let's say below 20, no, stepping to 20 a share minus GME.WS price. Okay? On 116. That's my first expectation. That could be right or wrong. We'll find out, and we'll find out for ourselves in due time. Right? Second expectation. Second expectation is earnings, quote, miss, end quote, on Q1 and Q4. Okay? Q1 miss larger than Q4 because I actually think there's a legitimate reason for earnings to have a negative impact, unlike Q4, which would probably do fantastically well as it usually does, but they're going to say it doesn't do well, and those are different. Okay. Next, expectations. What else do I expect? Fucking volatility into the 16th, fucking volatility into, yeah, let's say some sort of volatility. I don't know what, and I'm not going to be attached to what. Volatility between the 16th and February 15th. I don't know what's going to happen, but something is weird, and I'm open to it being weird. And February 15th is right here. It's the 10th, actually. It is the next peak on the main model, right? I'm expecting some sort of fucking weird-ass volatility to happen between this OPEX and the next predicted peak. Okay. Also, the swap page is confusing the shit out of me because it's... The swap page confuses the shit out of me because it's getting weirdly accurate. It is weirdly accurate. I don't want to hide that. But like 16th, and then the swap page thinks we rally. It's just... No, I'm not willing to do anything based off the swap page. The swap page is weird. I just want to say the swap page is weird. This is like an even lower correlation model than anything reasonable. But it's pretty weird and low IQ. Okay. Okay. Volatility between the 6th, 16th, and February 10th. I think that's it. I think that's all of my expectations. I'm going to call it. I'm going to keep it that simple because I've already gone pretty fucking long. And I'm fucking tired from talking. Y'all take care. Have a good one. Let me know if I can do anything for you.